Following its top performance in 2021, the energy stocks sector has been the most popular one in the market so far in 2022. What conclusions should we draw from that? And what does it suggest for the future? The fact that the energy industry had the lowest performance in 2020 should definitely be where we start. What's good, you guys? This is Market Thrive, and today we're going to be talking about the top 3 energy stocks we think it's a good buy right now, and of course why we think it's a good buy. Before we start the video, I would just like you to do me a favor by just hitting that subscribe button and the bell notification down below to keep you updated on this channel. So without further ado, let's hop into it. It can be viewed in 2 different ways. It would be simple for investors to conclude that the performance of energy stocks in 2021 to 2022 is just a component of a massive catch-up rally that may have now overshot its target. According to this perspective, energy stock prices had fallen to an extremely low level and had since increased to a level where they are fully valued. The other perspective holds that the energy market has undergone a fundamental shift, and that the rally that began in the middle of 2020 was merely the start of the market progressively recognizing the effects of that shift. To determine whether energy is still a smart buy right now, one must choose which direction to view the 2-year monster rally. Less emphasis is placed now than it did 10 years ago on the correlation between energy stocks and the highly volatile oil prices. In order to improve their balance sheets and lower financial debt, the majority of oil and gas corporations have benefited from the high prices during the first half of 2022. For each and every stock discussed in this post, this is accurate. At prices close to the average price for 2021, which was around $68 per barrel, all can run successfully and offer reliable future shareholder returns. This is probably towards the bottom of the range on which oil firms base their projected future revenues. Energy business CEOs are probably not as concerned about price swings around $90 per barrel as investors and the market appear to be. In general, the oil prices and level of volatility in 2021 are used as the basis for the underlying assumptions for the companies discussed in this article. So the question is now the right time to buy energy stocks? One of the 2 key questions is how to weigh the several timeframes at work with oil and gas and the energy sector. Over the greatest period of time, the energy sector has decreased from a bloated 28% in 1980 when it had been in the lead for the protracted 1970s commodity inflation cycle. Those who believed that energy stocks would only increase by 28% were in for a major letdown because it was evident that they had overshot their target. Most market segments saw improvements beginning in 1980. Energy prices rose again to 15% in 2000, and in 2010, they once more reached that mark. Energy stalled after that and dipped below 2% in November 2020, whereas tech has since taken the market by storm. Today, that number is roughly doubled. Long-term, technical advancement will trump energy, but in the short term, it seems that tech is overstretched while energy is on the rise. Whether the 2020 reversal could be considered a significant turning point is a key topic for investors. A succession of long-term highs in energy costs. Are they about to occur, or do they only reflect a variety of short-term issues at this time? The extremely challenging nature of replenishing reserves and the recent capital expenditures for exploration and production that have been relatively modest imply that such a long-term turning point was overdue. The intended S&P weighting is not 28% as it was in 1980, but it may be closer to 15% than it was in 2000 and 2010. This indicates that energy stocks are probably affordable from a longer-term vantage point. To be careful, however, is usually a good idea when an asset's price has lately tripled, as it has in the case of the Energy Select Sector ETF since April 2020. Since energy has been falling along with the rest of the market over the previous few days, the current market may be about to offer a dip buying chance. The current market slump may prompt investors to look for a buying opportunity. The first one is Enbridge. Enbridge is one of the largest oil pipeline companies in North America. The Canadian Pipeline Corporation, though, is aware of the situation's impending doom. This is motivating it to make significant investments in infrastructure development for lower carbon fuels. In terms of distribution and transportation of natural gas, it is rising to the top. Additionally, it has a sizable and expanding new energy and renewable power business. Enbridge's long-standing fossil fuels business generates a lot of steady cash flow, allowing the corporation to invest in low-carbon energy infrastructure and pay a dividend that now yields 6.2%. Though at least 2024, The company's backlog of secured capital projects, which mostly consist of offshore wind energy projects and natural gas distribution and pipeline expansions, should increase cash flow per share by 5% to 7% annually. That ought to sustain the ongoing dividend growth that Enbridge has experienced for 27 years running. The business, meanwhile, has a sizable annual investment capacity that will allow it to expand going forward. It also has a significant opportunity to keep growing its renewable energy operations, lower carbon gas infrastructure, and new energy businesses. That ought to provide Enbridge with enough fuel to keep expanding for years to come. The next one is Kinder Morgan. Similar guidelines are being followed by the massive Kinder Morgan natural gas pipeline company. Its aging infrastructure for fossil fuels produces a consistent cash flow. It now has the money to invest in growing its business and pay an enticing dividend that now yields 5.9%. The first focus of Kinder Morgan is on renewable natural gas. The business is spending $1.1 billion to develop an RNG platform that will utilize landfill methane. As these projects come up over the following few years, they will provide additional cash flow. Given the number of landfills releasing methane around the nation, Kinder Morgan believes that RNG based on landfills presents a significant possibility. In addition, the company is constructing 2 hubs for renewable diesel in California and a logistics and storage hub for renewable feedstock in Louisiana. With a huge chance to keep repurposing infrastructure for future fuel reuse, Kinder Morgan is using existing assets to support these future fuels. With the help of these investments, Kinder Morgan should be able to keep producing a significant amount of recurring cash flow to fund its dividend and growth. And lastly, we have the oil giant Chevron. It is investing in conventional and alternative energy while rewarding shareholders with a constantly increasing dividend and a significant share repurchase program utilizing its oil-fueled cash flows. The company is increasing its oil and gas output as well as its lower carbon businesses by capitalizing on the current robust demand for fossil fuels. Additionally, it is increasing its buyback program and dividend distribution, which yields 3.8% now, to distribute more money to shareholders. Chevron announced plans to triple its planned investment to $10 billion through 2028 in order to expedite its lower carbon goals last year. It aims to enhance the amount of RNG produced, the capacity for renewable fuels, the creation of green hydrogen, and the efficiency of carbon capture. The corporation launched a joint venture with Bunge to produce renewable fuel feedstock and spent more than $3 billion to buy Renewable Energy Group, making it a leader in the sector. By forming a joint venture to build a Texas hub for the development of an offshore subterranean reservoir to store the greenhouse gas, the oil corporation also improved its carbon capture and storage strategy. The company's dual focus will enable it to continue generating the fuels necessary for a cleaner future while also providing the economy with the immediate fuels it requires. Chevron should be able to continue producing a lot of money to return to investors as a result. So how long do you guys think it will last? If you like today's content, you'll sure love our previous video about the metaverse stocks, where we talk about why we think it's a good investment, which you can find in the description below. Feel free to jot down your thoughts in the comment section below. If you enjoyed today's video, please leave a like. And if you want to stay updated in our posts, hit that subscribe button as well. Once again, this is Market Thrive signing off.